Welcome to another Term Sheet Teardown. Today we're going to talk about pre-money and post-money, what they are, why they matter, and some of the nuances. And if you stick around, I'm going to give you a little bit of insight into the dark magic that is venture capital valuation. All right, let's jump into it. All right, so if you've seen any of my React videos, you know that the very first thing I do when the sharks are throwing out terms and the entrepreneur is asking for investment is I break down the pre-money and the post-money. And oftentimes, if you've watched those videos, which if you haven't, go check them out, you're able to see that like the valuation goes all over the place depending on how much the sharks are investing in the company, let alone like, you know, the amounts that they throw out. And so oftentimes what's happening is it seems like the shark is giving the entrepreneur a better deal at a higher valuation, but in reality, they're driving down the valuation because all the numbers that they report on are all post-money valuations. So let's dive into what I mean by that. So let's say that you are raising money for your startup and you meet with the VCs and the VCs say, you know what, I believe your startup is worth $9 million and I'm willing to invest $1 million. So you're going to invest $1 million. And the value of the company is $9 million. Now this is a pre-money valuation. And effectively what the venture capitalist is saying is that right now, before you take any money from me, if you were to like sell this company to somebody, it would be worth $9 million. Now that's not entirely accurate, right? I mean, you think about, you know, a couple of people with a great idea that raise money. Is their idea and they're like, you know, them as a team really worth millions of dollars? Probably not. And so this is where like art and science kind of comes into it, but we're going to come back to that. We're going to just talk about pre-money and post-money for now. So in this case, that's really though what's happening is the VC is saying your business today is worth $9 million. I'm going to give you $1 million. And so your post money is going to be $10 million post money. And basically the VC just bought 10% of your company, right? And that's what's happening here. And effectively then what happens after this is the VC is saying, okay, your post money, that's now your new valuation on the company. And it's presupposed that like, hey, if your company was worth $9 million before they invested and they gave you $1 million, well, that $1 million should be worth at least $1 million, right? Unless you like took it and immediately lit it on fire. And so if that's the case, then like, okay, great, 10% for $1 million plus I was worth 9 before, now I'm worth $10 million. Now let's talk about like what happens going forward. Well, if this was like your seed round, let's talk about what happens in your Series A. So at the Series A round, there could be a few different things that happen. You could have an up round. You could have a flat round. And you could have a down round. So let's explore each one of these and how they impact your pre and post money. Let's start with a flat round because it's probably one of the easiest to understand. In a flat round, you just continue to raise money at the same valuation as the seed round. So in that case, your pre-money would be equal to $10 million. Now it's equal to 10 million and not 9 million because after I put that $1 million in, I increased the valuation of the company, right? I gave you $1 million. And what you're really saying in a flat round is that $1 million I gave you, yeah, you used it and it was good, but you only really like turned $1 million into $1 million of value. And as a VC, that's not really what we're looking for. We want you to take that $1 million and turn it into a multiple of that $1 million, right? It's like this efficiency of your ability to put money to work, right? But there could be a lot of different things that happen that create a flat round. Some of it could be internal to the business. So maybe They thought they were going to close a big contract and it just didn't happen. Or it could be like external to the company, wherein like the economy just took a massive hit and valuations are broadly down. And so the company says, hey, look, we generated a lot of revenue from that money you gave us, but because valuations are down, our valuation is still relatively flat. So you could have, different things that result in a flat round. I would say flat round, if you can avoid a down round, flat round is pretty dang good. And in the current economy, where valuations are down a lot, capital is constrained, flat round is kind of the new up round. So let's talk about up rounds though. An up round is where you took that $1 million and you created a multiple of it in terms of value to the business, right? That could be you closed additional contracts, or you met certain large milestones, or you built an incredible product and were able to put all the features together and finish it. Whatever it takes to create more value within the business. So in that case, let's say we had an up round where the pre-money is going to be anything in excess of 10 million. So greater than 10 million is going to be an up round. Now, ideally, what venture capitalists are looking for is not just like we go from $10 million post money to $11 million post money. What we're looking for is you go from $10 million post money to $30 million pre-money, right? The next thing is you could have a down round. Now, down rounds you want to try to avoid as much as possible. But in essence, a down round is any time where the pre-money is less than $10 million. And in that case, everybody, including your prior investors, this investor that put in $1 million, just got diluted because the company is now worth less, right? And you can see this when we do general math. So let's say that this company raised at a $20 million up round, this one raised at that $10 million pre-money, and this one raised at a $5 million pre-money. Well, in this case, I own 10% of the business, and the value of my investment is $1 million. So in this up round, the value of my investment just went to $2 million because I own 10% of the company. And this is assuming these are all pre-money valuations here, going down. This one, the value of my investment is still worth $1 million. And in this case, the value of my investment is only worth $500K. And these are simply just 10% multiplied by each of these. So you can see, nobody really wants a down round because the value of their investment goes down, the value of your stock goes down, etc. Down rounds become really painful, though, as an entrepreneur, because if you have to raise additional capital, you're going to do it at a much lower valuation, and you're going to take a huge hit in terms of dilution. And VCs don't like this happening either with down rounds. So oftentimes they'll put in provisions that allow them to basically be issued shares if you raise at a higher valuation. And here's some of my tips if you're an entrepreneur. Oftentimes, especially in the last couple of years, there's been so much focus on this up round and getting a pre-money that's really high. And what's happened is these companies have basically said, you want to invest in my company, VCs, that all have way too much money? Great. You're going to do at a really high valuation so that I don't have to take very much dilution and give up too much of my company. But what that did is that they ended up being valued at way too high of valuations, right? There were companies that were being valued at 100 or even 1,000 times revenue, when in reality they should have been valued somewhere between 6 to maybe 15 times revenue. And what that's led to is that today, in today's environment, they are valued at 10 times revenue, not 100 times revenue. And so if you didn't grow your revenue by 100 times in the last year and a half, then you're going to have to take a down round. And not only are you going to have to take a down round, but it's probably going to be really hard to raise capital right now. And so not only are you taking a down round, it might be a down round plus it might be some structure, like you're going to have to pay up a higher liquidation preference or what have you. So I always guide entrepreneurs and give them feedback, that they should be very thoughtful about where they put their pre-money valuation. Because sometimes they'll get into this game and they'll say, hey, I want the high valuation. And the VCs say, okay, I'll give you the high valuation, but I'm going to put a bunch of terms in there, like ratchets and other things that end up really hurting the entrepreneur if they're not able to grow into that valuation, which can be really tough. And the reality too is that the more hair, as we call it in the industry, there is on a deal, the less likely a new VC really wants to participate. Because ultimately, like, the majority of deals that are really successful don't have a bunch of hair on them, don't struggle a ton, right? And VCs, like, we want to invest in the winners that are going to grow and be really big and successful, and kind of cut our losses on some of the losers. I was meeting with a VC a few months ago. He made a good point. So their fund was an investor that raised a fund in like 2000, 2001, somewhere in there, and started making investments. And they actually made 3 phenomenal investments. Like, these companies absolutely crushed it. And you would know the names of them if I were to tell you on this channel. Anyways, so what they did is they said, oh, we've got these 3 companies. These companies are good. They don't need any more money. They're growing. We're going to take the rest of our money. We're going to plow it into the companies that are struggling. So they did that. They took their remaining cash. They invested in all the companies that were struggling. Pretty much all those companies that were struggling still went out of business or barely returned the capital that they had invested. And he looked back and he's like, if what we should have done is we should have just said, you know what, all of these companies that are struggling, we're going to write them all off. And we're going to take all of this cash that we've got and we're going to plow it into our 3 winners. And he was like, if we had done that, we would have generated an insane return. He was like, as it is, those 3 companies saved our fund and allowed us to raise another fund. He's like, but we could have made so much more money for our investors if we had just triaged things a little bit better and put the money where it belonged. And I think really smart investors do that. And that makes it really challenging if you're a startup that overvalued your company in prior rounds in order to attract really great investors for your next rounds if you didn't grow into that prior valuation. So my advice is just be really careful about how you price your pre-money and how much money you take, because it can really impact your ability to fundraise in the future. So I promised you a little bit of insight into the black magic that is venture capital valuations. Now here's the thing. There are a lot of things that go into determining what the valuation should be from a venture capitalist mindset. And I'll tell you right now, it basically boils down to 3 key things. The first is this idea of expected outcome. So if I invest in this company, given the risks, the team, the opportunity, the market size, all of those different factors, and the risk associated with the company achieving success according to each one of those factors, how big could this company get, right? And what's the likelihood of them getting to that outcome? So for example, if I think a company has the ability to get to a $100 billion valuation, I will be willing, all things considered, to pay more for that company on a valuation basis today than a company that only has like $100 million potential in terms of valuation in the future, right? So there's that component of it. And that's where sometimes you see companies that, raise at multi-billion-dollar valuations because they have the opportunity to eventually be worth $100+ billion. The next factor that really comes into play for VCs is oftentimes they have ownership percentages that they need to hit, or ownership targets that they need to hit for the business. So a lot of Series A funds need to own 25% of a company, for example. And so the amount, they will then go to the company and say, hey, I need to own 25% of your business. How much money do you need, right? And they'll play around with the valuation until they can get to their ownership number. In which case, it's not really about like where the company is today as much as it is about the ownership target they need to hit. And then the last piece is, at the end of the day, the VCs don't run the business. We don't want to run the business. If I have to come in and take over operating the business, I have already failed. So that's not my goal. I want amazing entrepreneurs to run the business, and I want them to be incentivized to grow this into something huge. And so there's also like this piece of the puzzle, which is making sure that the entrepreneurs are incentivized to continue to run the business. And not just today, but in the future as well. Because if I invest at too low of a valuation, then the next investor is going to invest, and the founder's going to get diluted even more and more and more. And pretty soon, if we didn't get it right in the early days, pretty soon they may not own enough of the business to be incentivized to keep driving it and growing it, which doesn't really help us as investors. So those are some of the dynamics that are all happening right within the VC's mind as they're thinking about what's the right valuation in order to win this deal. Anyways, I hope that was helpful. Check out some of my other term sheet teardowns like pro-rata rights. Thanks.